What's the suspense that we're going to see over the next 48 hours for the Fed?
Yeah, so the real question is, obviously they teed up a March rate hike a few weeks ago when everybody wasn't expecting it. So what is the reason for that? Is it because they want to hike more times this year than we thought before, or is this more just about pulling the timing forward and maybe, buying some optionality so that you can kind of wait and see what happens later in the year after you do more rate hikes? So that's the big question. How is she going to handle that signaling about the path? They always say it's the path that matters. How is she going to handle that?
And the question is, yes, we've seen 10-year yields back up to 2.6%, but real yields that were moving lower have now started to move higher. I mean, the 10-year real yield's about like 60 basis points, right? Because it feels like inflation expectations aren't cemented in stone. We don't necessarily believe it.
Yeah, and I brought you guys a chart because I like to look at the 5-year real yield because it's been bouncing right around that zero level for the last 4 years almost now. And we've tried to break this zero level multiple times over that time period. And you can see that every time we've gone above zero, we've come back down. So now we're kind of starting to poke up above zero again today. It'll be interesting to see if financial markets, the economy can handle these positive real yields because so far we haven't really seen that sustained positive break. So is this it, finally?
Fair. And Greg, part of the reason why it felt like the markets were okay with a Fed hike is because we see financial conditions have become much looser. What happens if real rates continue to climb higher? Does that really put off the Fed for the rest of the year in 2018?
I think we'll see. I think, it's a really interesting time, right? If you look back over the past few years, it's really been a situation where the markets have underpriced what the Fed has been telling the marketplace, and that's actually quite unique. But I think the change today is that if the markets actually, as it typically does, starts to overprice what the Fed is telling you. And so if you look at what's being priced in the market, the dots are telling you, 3 hikes each year over the next 3 years. But the market is really fading that, right? So it has 3 hikes this year still, but only about 2 hikes next year and then 1 hike the following year. So I think the markets and financial conditions stabilize around the markets pushing back on the notion that the Fed will hike to the dots. But if that changes, or if the market actually prices in even more, then I think that is a real change in financial conditions and is not great for risk assets.
Well, exactly, Rick. And you're not as sanguine about all these rate hikes as some people are. You think that the market might be getting ahead of itself a little bit. What's the downside risk here?
Yeah, so I think the downside risk is really trying to manage against what seems to be a slightly stronger economic backdrop versus pretty expensive valuations. And just thinking about this, this week alone, this is a central bank bonanza this week, right? So you have the Fed, the BOJ, the Bank of England, and the Nordis Bank. And then you also have noise around D.C. With healthcare, and then you have, Brexit coming to the fore finally. So I think the markets are somewhat susceptible here, and I think the Fed is front and center.
So how do you position yourself as an investor in that world?
Yeah, so, much more cautiously. So we were, very much a max risk in our total return bond fund. We have dialed that back pretty meaningfully over the last month or so. And so we are definitely taking some chips off the table. The high yield market in particular is an area that we've been somewhat max bullish on. And just looking at valuations, we have pulled back and become much more defensive. That's the first thing. The second is around rates. I know there's this prevailing view that rates need to move much higher. We are leaning against that view. And so obviously the past few days or so, rates have moved higher. But I think what the market is missing to a certain degree is the lack of real growth and the lack of inflation. And if the Fed is actually more proactive in here, all else being equal, that will push rates lower, not higher.
It's bumming us out on the one side. Matt, what happens to the terminal rate?
That's another good question. I think, it's gone up since the election, of course, because we've had, some more optimism about the term, how far we can get. But the interesting thing is we are kind of returning to that dynamic where, later in a tightening cycle, you have more tightening priced for right in front of you, like this year, for example, but then tightening in the back years starts to kind of go down a little bit. And so we are kind of seeing that where, as before, the Fed was trying to run things hot at the beginning, and then hopefully that would boost that sort of terminal rate later. Now they're kind of doing the opposite. So it's not clear. We probably need some sort of other type of shift like we had in the election if that's going to go materially higher again.